This is TechCrunch. AI research lab Anthropic announced on Monday that it signed a new agreement with Google and Broadcom for increased processing and compute capacity to power its Claude AI models. This reworking of its compute deals comes as demand for its AI models continues to soar. Now, the deals would expand Anthropic's use of Google Cloud's Tensor Processing Units, or TPUs, the company's advanced AI chips, and is an expansion of the deal the companies struck back in October of last year for more than a gigawatt of compute capacity. The company said that this new compute capacity will come online in 2027, but they did not give specifics for its compute expansion. But a recent Broadcom SEC filing shows the deal includes 3.5 gigawatts of compute. The majority of this compute will be housed in the U.S. and will be an extension of the company's $50 billion commitment to invest in U.S. compute infrastructure. Krishna Rao, CFO of Anthropic, said that this groundbreaking partnership with Google and Broadcom is a continuation of our disciplined approach to scaling infrastructure. We are building the capacity necessary to serve the exponential growth we have seen in our customer base, while also enabling Claude to define the frontier of AI development. We're making our most significant compute commitments to date to keep pace with our unprecedented growth. The company has seen demand for its Claude models explode in recent months, buoyed by enterprise customers and despite the U.S. Defense Department's labeling of Anthropic a supply chain risk. Anthropic also recently closed a $30 billion Series G funding round that valued the company at $380 billion. The company's run rate revenue is now $30 billion, marking a drastic jump from the $9 billion the company recorded at the end of 2025. Anthropic also has more than 1,000 business customers spending more than $1 million on an annualized basis. For decades, buying stock in a hot startup meant being allowed to invest in the funds run by the top VCs. But with the AI boom causing an investment frenzy, more family offices and private wealth are skipping the VC middlemen to get directly onto the cap table. Mitch Stein, founder of Arena Private Wealth, an investment advisory firm for high-net-worth individuals, told TechCrunch that companies are staying private longer and there are fewer IPOs now than we've seen historically. A lot of money is being made well before companies go public, and right now the private markets are dominated by a lot of these AI names. The family offices who are allocating directly into AI startups are right on. Arena recently co-led a $230 million round into AI chip startup Positron, an investment that earned the Midwestern firm a board seat. Stein says that part of a deliberate shift away from being passive allocators and towards becoming active participants in the capital markets. The urgency amongst today's family offices is real. Ari Schottenstein, Arena's head of alternatives, told TechCrunch, "The world's AI infrastructure is being built now, so you're either going to get in early and have an opportunity to do more primary investing and really build a portfolio, or you're going to miss it and be taking random bets." Stein actually put it more bluntly. Your biggest risk is not having exposure to AI, not what could happen to your AI investments. The numbers reflect that statement. Back in February, family offices made 41 direct investments into startups, nearly all of them tied to AI. Among those are high-profile names like Lorraine Powell Jobs' Emerson Collective into World Labs, Azim Premji's family office into Runway, and Eric Schmidt's Hillspire into Goodfire. According to BNY Wealth Research, 83% of family offices say AI is a top strategic priority over the next 5 years, and more than half have AI exposure through investments. Some are going further still. A growing number of family offices are incubating their own AI companies, seeding the first several million, taking on operational roles, and deploying the same entrepreneurial instincts that built their wealth in the first place. Jeff Bezos' decision to serve as CEO of his own robotics company, which raised an initial $6.2 billion last year at a nearly $30 billion valuation, is a high-profile example of that model. On a smaller scale, Stein pointed to Tyson Tuttle, an Austin-based angel investor and former CEO of Silicon Labs, which agreed to be acquired by Texas Instruments for $7.5 billion. Tuttle co-founded Circuit, a startup using AI to improve manufacturing and distribution, raising a $30 million angel round that includes $5 million from his own family office. Now, not everyone coming to the table has founded a company, though. Arena's team comes from institutional finance, and they argue that rigorous due diligence is what earns them the right to lead rounds. Schottenstein said, "We take our time. We're a very slow yes. We say no a lot. We definitely invest in the sources and experts and people necessary to make sure that a company is what it says it is and can do what it says it will do." For the positron deal, that meant working with third-party experts to validate the technology, but also reading the cap table itself as a signal. Again, Schottenstein said that if ARM is coming into a deal, we'd like to think your technology is real. Arena also knew Oracle was a major customer, making positron one of the only AI chips deployed into a hyperscaler not named NVIDIA or AMD. That selectivity shapes how Arena participates once it's in. Unlike a typical VC spreading risk across a portfolio, Arena makes a small handful of direct deals per year, which changes the stakes entirely. When they're in, they are all in. Positron is their one and only AI inference chip investment. That's all for now. For more stories like these, go to TechCrunch.com.